At this time of year, many of us naturally reflect on the months behind and prepare for the year ahead. It's also an ideal moment to pause and take stock of your financial picture so that you can enter the new year on solid footing. Today, we want to share several areas worth reviewing before December 31st and highlight key opportunities in light of recent tax law changes. Every year brings new developments, family milestones, career changes, or shifting priorities. It's important to revisit the goals that you set earlier this year and ask yourself whether they still align with where you are now. Have there been meaningful changes in your life, your spending goals, your family dynamics that affect your financial plan or your investment strategy? Taking time to reflect creates the space to recognize changes and adjust your plan so that it stays on track. It's also helpful to review your spending. By looking at year-to-date statements, credit card summaries, or using digital budgeting tools, you can form a clear picture of how you're spending your money. The goal is not to track every dollar, but to confirm whether your spending and savings align with the lifestyle that you intend to maintain, and to identify opportunities to redirect resources towards higher priorities. Often, these reviews reveal patterns such as unused subscriptions or unplanned spending that can be reallocated towards meaningful goals like travel, family experiences, or additional savings. Also, review your emergency reserves to ensure that your cash balance or your investment in defensive assets can support you during periods of volatility or unexpected expenses. This is also a great time to take a look at your insurance coverage and confirm that things like homeowners, liability, cyber protection, and for those who are serving on boards, your directors and officers insurance remains at appropriate levels and coverage for your lifestyle and needs. These kind of reviews can help ensure that your wealth is protected against unexpected risks. It's, of course, also essential to review your annual retirement contributions and distributions before the end of the year. For those who are still building wealth, check to make sure that the contributions to your retirement accounts like 401ks and IRAs are on track. Even little increases can compound significantly over time. If you're already retired, work with your portfolio manager and your tax advisor to ensure that any required distributions have been satisfied, and think about whether your withdrawals are structured in a tax-efficient manner across taxable, tax-deferred, and tax-free accounts. Speaking of your accounts, year-end is a great time to consider consolidating and simplifying where you can. Over time, it's common to accumulate multiple accounts across different providers. While this is understandable, it can complicate efforts to track performance, manage risk, maintain tax efficiency, and prepare accurate tax reports at the end of the year. This is a great time to evaluate your accounts across the board, identify inconsistencies, and consider whether consolidating accounts would simplify administration and provide clearer oversight. Of course, our team is happy to help you assess the benefits of consolidation and weigh considerations like tax impact or fee implications, and handle all of the paperwork for a smooth transition. This year also brought significant policy changes with the passage of the 2025 Tax Act, sometimes also called the One Big Beautiful Bill Act. Among other provisions, it extended many of the aspects of the 2017 tax reform and makes the current federal estate tax exemption permanent. Though future legislation, of course, can always alter this landscape. One important consideration that has planning implications today is charitable giving. Beginning next year, the new law introduces some new rules. For those who are not itemizing, a new deduction will allow cash gifts to public charities of up to $1,000 for individuals and $2,000 for married couples filing joint. For those who are itemizing, there's going to be a new 0.5% of adjusted gross income floor that will apply. This means that your charitable contributions will only be deductible to the extent that they exceed that 0.5% floor. Also, for those in the top federal tax bracket, the value of itemized deductions, including charitable donations, will be modestly limited starting next year, reducing the tax benefit from 37% to 35%. Next, cash gifts to public charities will remain deductible up to 60% of your adjusted gross income, And those that are donations of appreciated securities will remain capped at 30%, with any excess non-deductible contributions still carrying forward for 5 years. So, what this means is that for individuals who are contemplating larger charitable gifts, it may be advantageous to accelerate them into 2025 before these new rules take effect. We recommend discussing timing and strategy with your portfolio manager and your tax advisor to decide what is going to make the most sense for you. As we wrap up, remember to address any remaining year-end tasks like annual exclusion gifts to family, using up your flexible spending accounts, or making contributions to 529 education savings plans. For updated limits and planning details, please watch out for our October blog or reference our annual financial planning guide. If you would like to revisit your financial plan or charitable strategy before year-end, please reach out to your portfolio manager. Together with your tax advisor, we can fine-tune your strategies to align with your long-term goals. Thank you, as always, for your continued trust in Ferguson Wellman. We wish you a strong conclusion to this year and a successful beginning to the next one.